Hey friends! Today we are going to start a new course of elementary session, which is Fibonacci. In this course we will learn below Fibonacci retracement tool. Fibonacci trading. How to use Fibonacci retracement to enter a trade. Fibonacci retracements are not foolproof. How to use Fibonacci retracement with support and resistance. How to use Fibonacci retracement with trend lines. How to use Fibonacci retracement with Japanese candlesticks. How to use Fibonacci extensions to know when to take profit. How to use Fibonacci to place your stop so you lose less money. Summary: Fibonacci trading. So let's start with first topic, Fibonacci trading. We will be using Fibonacci ratios a lot in our trading, so you better learn it and love it like your mother's home cooking. Fibonacci is a huge subject and there are many different Fibonacci studies with weird sounding names, but we're going to stick to two: retracement and extension. Let us first start by introducing you to the Fib man himself, Leonardo Fibonacci. No, Leonardo Fibonacci isn't some famous chef. Actually, he was a famous Italian mathematician, also known as a super-duper uber ultra geek. He had an aha moment when he discovered a simple series of numbers that created ratios describing the natural proportions of things in the universe. The ratios arise from the following number series: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144. This series of numbers is derived by starting with 0 followed by 1 and then adding 0 plus 1 to get 1, the third number. Then, adding the second and third number, 1 plus 1, to get 2, the fourth number, and so on. After the first few numbers in the sequence, if you measure the ratio of any number to the succeeding higher number, you get 0.618. For example, 34 divided by 55 equals 0.618. If you measure the ratio between alternate numbers, you get 0.382. For example, 34 divided by 89 equals 0.382, and that's as far as into the explanation as we'll go. These ratios are called the golden mean. Okay, that's enough mumbo jumbo. With all those numbers, you could put an elephant to sleep. We'll just cut to the chase. These are the ratios you have to know. Fibonacci retracement levels are 0.236, 0.382, 0.500, 0.618, 0.764. Fibonacci extension levels are 0, 0.382, 0.618, 1.000, 1.382, 1.618. You won't really need to know how to calculate all of this. Your charting software will do all the work for you. Besides, we've got a nice Fibonacci calculator that can magically calculate those levels for you. However, it's always good to be familiar with the basic theory behind the indicator so you'll have the knowledge to impress your date. Fibonacci retracement levels work on the theory that after a big price move in one direction, the price will retrace or return part way back to a previous price level before resuming in the original direction. Traders use the Fibonacci retracement levels as potential support and resistance areas. Since so many traders watch these same levels and place buy and sell orders on them to enter trades or place stops, the support and resistance levels tend to become a self-fulfilling prophecy. Traders use the Fibonacci extension levels as profit-taking levels. Again, since so many traders are watching these levels to place buy and sell orders to take profits, this tool tends to work more often than not due to self-fulfilling expectations. Most charting software includes both Fibonacci retracement levels and extension level tools. In order to apply Fibonacci levels to your charts, you'll need to identify swing high and swing low points. A swing high is a candlestick with at least two lower highs on both the left and right of itself. A swing low is a candlestick with at least two higher lows on both the left and right of itself. Let's move to second topic: how to use Fibonacci retracement to enter a trade. The first thing you should know about the Fibonacci tool is that it works best when the Forex market is trending. The idea is to go long, or buy, on a retracement at a Fibonacci support level when the market is trending up, and to go short, or sell, on a retracement at a Fibonacci resistance level when the market is trending down. Fibonacci retracement levels are considered a predictive technical indicator since they attempt to identify where price may be in the future. The theory is that after price begins a new trend direction, the price will retrace or return part way back to a previous price level before resuming in the direction of its trend. Finding Fibonacci retracement levels. In order to find these Fibonacci retracement levels, you have to find the recent significant swing highs and swings lows. Then, for downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, do the opposite. Click on the swing low and drag the cursor to the most recent swing high. Got that? Now, let's take a look at some examples on how to apply Fibonacci retracements levels to the currency markets. Uptrend. This is a daily chart of Australian dollar to US dollar. Here we plotted the Fibonacci retracement levels by clicking on the swing low at 0.6955 on April 20th and dragging the cursor to the swing high at 0.8264 on June 3rd. Ta-da! The software magically shows you the retracement levels. As you can see from the chart, the Fibonacci retracement levels were 0.7955, 23.6%, 0.7764, 38.2%, 0.7609, 50.0%, 0.7454, 61.8%, and 0.7263, 76.4%. Now, the expectation is that if Australian dollar to US dollar retraces from the recent high, it will find support at one of those Fibonacci retracement levels because traders will be placing buy orders at these levels as price pulls back. Now, let's look at what happened after the swing high occurred. Price pulled back right through the 23.6% level and continued to shoot down over the next couple of weeks. It even tested the 38.2% level but was unable to close below it. Later on, around July 14th, the market resumed its upward move and eventually broke through the swing high. Clearly, buying at the 38.2% Fibonacci level would have been a profitable long-term trade. Downtrend. Now, let's see how we would use the Fibonacci retracement tool during a downtrend. Below is a 4-hour chart of Euro-USD. As you can see, we found our swing high at 1.4195 on January 25th and our swing low at 1.3854 a few days later on February 1st. The retracement levels are 1.3933, 23.6%, 1.3983, 38.2%, 1.4023, 50.0%, 1.4064, 61.8%, and 1.4114, 76.4%. The expectation for a downtrend is that if price retraces from this low, it could possibly encounter resistance at one of the Fibonacci levels because traders who want to play the downtrend at better prices may be ready with sell orders there. Let's take a look at what happened next. Yowza, isn't that a thing of beauty? The market did try to rally, stalled below the 38.2% level for a bit before testing the 50.0% level. If you had some orders either at the 38.2% or 50.0% levels, you would have made some mad pips on that trade. In these two examples, we see that price found some temporary forex support or resistance at Fibonacci retracement levels. Because of all the people who use the Fibonacci tool, those levels become self-fulfilling support and resistance levels. If enough market participants believe that a retracement will occur near a Fibonacci retracement level and are waiting to open a position when the price reaches that level, then all those pending orders could impact the market price. One thing you should take note of is that price won't always bounce from these levels. They should be looked at as areas of interest, or as Cyclope likes to call them, kill zones. We'll teach you more about that later on. For now, there's something you should always remember about using the Fibonacci tool, and it's that they are not always simple to use. If they were that simple, traders would always place their orders at Fibonacci retracement levels and the markets would trend forever. In the next lesson, we'll show you what can happen when Fibonacci retracement levels fail. Let's talk now about Fibonacci retracements are not foolproof. Back in grade 1, we said that support and resistance levels eventually break. Well, seeing as how Fibonacci levels are used to find support and resistance levels, this also applies to Fibonacci. Fibonacci retracements do not always work. They are not foolproof. So see the message in this picture. Don't be a fool. Be careful when you use the Fibonacci tool. Let's go through an example when the Fibonacci retracement tool fails. Below is a 4-hour chart of GBP/USD. Here, you see that the pair has been in downtrend, so you decided to take out your Fibonacci retracement tool to help you spot a good entry point. You use the swing high at 1.5383, with a swing low at 1.4799. You see that the pair has been stalling at the 50.0% level for the past couple of candles. You say to yourself, oh man, that 50.0% Fib level. It's holding baby. Time to short this sucker. You short at market and start daydreaming that you'll be driving down Rodeo Drive in your new Maserati with Scarlett Johansson, or if you're a lady trader, Ryan Gosling, in the passenger seat. Now, if you really did put an order at that level, not only would your dreams go up in smoke, but your account would take a serious hit if you didn't manage your risk properly. Take a look at what happened. It turns out that swing low was the bottom of the downtrend and market began to rally above the swing high point. What's the lesson here? While Fibonacci retracement levels give you a higher probability of success, like other technical tools, they don't always work. You don't know if price will reverse to the 38.2% level before resuming the trend. Sometimes it may hit 50.0% or the 61.8% levels before turning around. Heck, sometimes price will just ignore Mr. Fibonacci and blow past all the levels, just like how LeBron James bullies his way through the lane with sheer force. Remember, the market will not always resume its uptrend after finding temporary support or resistance, but instead continue to go past the recent swing high or low. Another common problem in using the Fibonacci retracement tool is determining which swing low and swing high to use. People look at charts differently, look at different time frames, and have their own fundamental biases. It is likely that Stephen from Pip-But-2 and the girl from Pi Panama have different ideas of where the swing high and swing low points should be. In the next lesson, we'll show you how to use the Fibonacci retracement tool in combination with other forms of support and resistance levels and candlesticks. Now we'll tell you how to use Fibonacci retracement with support and resistance. Like we said in the previous section, using Fibonacci levels can be very subjective. However, there are ways that you can help tilt the odds in your favor. While the Fibonacci retracement tool is extremely useful, it shouldn't be used all by its lonesome self. It's kinda like comparing it to retired NBA superstar Kobe Bryant. Kobe is one of the greatest basketball players of all time, but even he couldn't win those titles by himself. He needed some backup. Similarly, the Fibonacci retracement tool should be used in combination with other tools. In this section, let's take what you've learned so far and try to combine them to help us spot some sweet trade setups. Are y'all ready? Let's get this pip show on the road. Fibonacci retracement plus support and resistance. One of the best ways to use the Fibonacci retracement tool is to spot potential support and resistance levels and see if they line up with Fibonacci retracement levels. If Fibonacci levels are already support and resistance levels, and you combine them with other price areas that a lot of other traders are watching, then the chances of price bouncing from those areas are much higher. Let's look at an example of how you can combine support and resistance levels with Fibonacci levels. Below is a daily chart of USD CHF. As you can see, it's been on an uptrend recently. Look at all those green candles. You decide that you want to get in on this long USD CHF bandwagon. But the question is, when do you enter? You bust out the Fibonacci retracement tool, using the low at 1.0132 on January 11th for the swing low and the high at 1.0899 on February 19th for the swing high. Now your chart looks pretty sweet with all those Fibonacci retracement levels. Now that we have a framework to increase our probability of finding solid entry, we can answer the question, where should you enter? You look back a little bit and you see that the 1.0510 price was good resistance level in the past, and it just happens to line up with the 50.0% Fibonacci retracement level. Now that it's broken, it could turn into support and be a good place to buy. If you did set an order somewhere around the 50.0% Fib level, you'd be a pretty happy camper. There would have been some pretty tense moments, especially on the second test of the support level on April 1st. Price tried to pierce through the support level, but failed to close below it. Eventually, the pair broke past the swing high and resumed its uptrend. You can do the same setup on a downtrend as well. The point is, you should look for price levels that seem to have been areas of interest in the past. If you think about it, there's a higher chance that price will bounce from these levels. Why? First, as we discussed in Grade 1, previous support or resistance levels would be good areas to buy or sell because other traders will also be eyeing these levels like a hawk. Second, since we know that a lot of traders also use the Fibonacci retracement tool, they may be looking to jump in on these Fib levels themselves. With traders looking at the same support and resistance levels, there's a good chance that there are a ton of orders at those price levels. While there's no guarantee that price will bounce from those levels, at least you can be more confident about your trade. After all, there is strength in numbers. Remember that trading is all about probabilities. If you stick to those higher probability trades, then there's a better chance of coming out ahead in the long run. Let's move into the another topic: how to use Fibonacci retracement with trend lines. Another good tool to combine with the Fibonacci retracement tool is trend line analysis. After all, Fibonacci retracement levels work best when the market is trending, so this makes a lot of sense. Remember that whenever a pair is in a downtrend or uptrend, traders use Fibonacci retracement levels as a way to get in on the trend. So why not look for levels where Fib levels line up right smack with the trend? Here's a 1-hour chart of AUD/JPY. As you can see, price has been respecting a short-term rising trend line over the past couple of days. You think to yourself, that's a sweet uptrend right there. I want to buy Australian dollar to Japanese yen, even if it's just for a short-term trade. I think I'll buy once the pair hits the trend line again. Before you do that though, why don't you reach for your Forex toolbox and get that Fibonacci retracement tool out? Let's see if we can get a more exact entry price. Here we plotted the Fibonacci retracement levels by using the swing low at 82.61 and the swing high at 83.84. Notice how the 50.0% and 61.8% Fib levels are intersected by the rising trend line. Could these levels serve as potential support levels? There's only one way to find out. Guess what? The 61.8% Fibonacci retracement level held, as price bounced there before heading back up. If you had set some orders at that level, you would have had a perfect entry. A couple of hours after touching the trend line, price zoomed up like Astro Boy bursting through the swing high. Aren't you glad you've got this in your trading toolbox now? As you can see, it does pay to make use of the Fibonacci retracement tool, even if you're planning to enter on a retest of the trend line. The combination of both a diagonal and a horizontal support or resistance level could mean that other traders are eyeing those levels as well. Take note though, as with other drawing tools, drawing trend lines can also get pretty subjective. You don't know exactly how other traders are drawing them, but you can count on one thing: that there's a trend. If you see that a trend is developing, you should be looking for ways to go long to give you a better chance of a profitable trade. You can use the Fibonacci retracement tool to help you find potential entry points. So friends, we are going to finish this video here only as first part of Fibonacci. In next video we will cover remaining topics of Fibonacci, which is how to use Fibonacci retracement with Japanese candlesticks, how to use Fibonacci extensions to know when to take profit, how to use Fibonacci to place your stop so you lose less money, and summary, Fibonacci trading. So stay tuned.